Afternoon, everyone. We are happy to welcome you on this key tax changes in the Baltics webinar brought to you together with three Baltic states tax colleagues. My name is Vykintas Valiulis. I am head of tax in Thornton, Lithuania, and together with Estonian colleagues, Kristjan Järve and Jaana Sild, as well as Latvian colleague Mārtiņš Lubgans, we will guide you through today on what is changing in tax landscape in the Baltics. But firstly, let me also express gratitude to Chambers of Commerce of Estonia, Latvia, Sweden, and Norway, who helped us in promoting this webinar, and I hope that their members will also be happy to be briefed about key tax changes in the Baltics. As the most of the changes were happening in Estonia this year, that was the most active jurisdiction this year. Then in second place by amount of changes was Latvia. Let's start today by going from north to south, so to speak. And I am giving then word to Estonian colleagues, Kristjan Järve and Jaana Sild, please. And starting sharing slides.
Yeah, hello. Good afternoon to everyone. And it's a pleasure to see such a large audience here. I will now switch off the camera. In that case, maybe it's you have a more real estate to follow the content of slides. So, about Estonia. To give you some background, in the second half of last year, Estonia experienced a true tax festival, a new definition invented by our new Prime Minister. And you could ask, why was it really necessary to do all of this in such a short period? And we have to understand that following the minor government reform, last year it was decided that politically it would be much more advantageous to announce all possible tax increases and all new tax types at once. So that the negative impact will drop by the end of the next elections. The catalyst was, of course, the urgent need to rapidly increase defense investments and to comply with a new EU stricter budget deficit requirement, which is 3%. Anyway, whether the chosen strategy will prove effective remains to be seen. And but what is clear, however, as a result of such a multitude of tax increases, the competitiveness of Estonian companies will certainly decrease in short term. And of course, also individuals' purchasing power will decrease, and inflation is probably like to rise again in short term as well. So that's shortly about the context. So let's start with tax rates. Here you can see the 25 tax rates at glance, and later you can compare it with a similar table of Latvian and Lithuanian rates. As you can see, besides social taxes, all the other tax rates are increased and will increase even further during 25 and in the beginning of 26. You can see here that as of 1st of January, both the corporate and income tax rate has been increased 2%. And due to the specifics of Estonian cash-based taxation. Then if we actually compare the effective tax rate increase, because we are taxing the net distribution, then actually the actual tax increase has been even more, 3.2. It was before 25 and now 28.2%. And also the VAT standard rate will be increased again as of 1st of July 25, up to 24%. So these are right now the 25 rates, but we will explain later because additional increases will come in 26 as well. So the only positive side is that the minimum wage increased a little bit, 66 euros, but considering the cost of living and, for example, the minimum wage in Lithuania, which is, if I'm correct, 1,038 euros per month, there is a little reason to feel proud. The initially planned basic exemption reform, a uniform 700 per month for everyone, was postponed by 1 year due to the budget deficit. So the current basic exemption, which you can see here, which is progressive, depending the salary, has remained right now the same. Yes, and about the VAT rates, the reduced rates have been also increased. According to the VAT directive, we can have only 2 reduced rates. It was 5 and 9 before. Now it is 9 and 13. And Jaana will tell about this later more. And VAT registration threshold has remained the same, but the basis for its calculation has changed due to the directive. But that's also something which Jaana will elaborate later. So let's move forward. So we have now the new type of tax, so to speak. Technically, it's a separate law that adds various elements to the taxation of companies and individuals and temporarily increases tax burden. And it is called defense tax law, but as it contains different elements for the different type of taxes, then we will call it as a defense tax package here. And the general objective is, this is like a measure aimed to strengthen the national defense capabilities. But in practice, of course, the revenues collected through this are not solely allocated to defense expenditures and are also used probably to patch other budget deficits. And about the temporary nature, yeah, it is to the law applicable until 28, but as we know all that nothing is more permanent than temporary measures, so we will see. And about rates, VAT rate will increase additionally 2%. Standard rate already increased last year from 20 to 22 and will be now in this year, 1st of July, increase again by 2%. Second element is the corporate profits, but we will speak about that soon because the 2% is not just the increase of a corporate tax rate system as we have right now, the cash-based, but it also includes the totally new type of tax base. And the last is 2% increase of tax for personal income. Again, it's not exactly just the increase of income tax rate as such, because the tax base is a little bit broader than just ordinary income tax. But we will elaborate that So first element here is the corporate taxation, which is applicable to profits of resident companies and also the permanent establishments located in Estonia. Exactly how it is right now with cash-based system, which is also applicable both for the resident companies and permanent establishments of foreign companies in Estonia. And tax base is pre-tax accounting profit. If company is operating at a loss, of course, there are no tax obligation under the current system or under the new system. The biggest problem is unrealized gains, which are included in the tax base. We will speak about that. And the double taxation is avoided. It means that if you have many layers in your group structure, regardless whether you have subsidiaries in Estonia, who are also generating the profit, then they are paying their part, and the Estonian shareholder as a company, parent company, will not pay the tax twice. And if Estonian company is a holding entity for foreign investments, there are no double taxation. Foreign dividends, if Estonian company owns more than 10%, and then and the tax has been paid in abroad. Let's say we have a subsidiary in Latvia or Lithuania, then receiving the dividends from Lithuanian and Latvian subsidiaries, and later redistributing those dividends to the shareholders, even if you are from Latvia or Lithuania, then no additional Estonian corporate tax, either the main cash-based 22%, nor also the additional 2% accrual tax will apply. So the double taxation in this case is avoided. The problem is with non-business expenses and the transfer pricing adjustments, because if we see the profit and loss statement, the last row before the tax liability, then in pre-accounting profit, usually if the company had non-business related expenses at the time, then this tax has been already deducted from the income. It means the tax base for the defense tax has been also already technically decreased. But the government would like to get the maximum amount on such expenses. So first of all, the company will pay the corporate tax 22% from net to gross on non-business expenses. And secondly, this tax cannot be deducted from the pre-tax profit for the defense tax calculation purposes. So that's the logic here. And the taxation period is financial year, and we will have also the quarterly advance payments. So the biggest surprise here, I think, both for the local investors and the foreign investors, is you have to realize that that unrealized profit and revenues taxation is quite unique. The reason is that states simply didn't have enough time to create a fair accrual-based tax system, and also lacked expertise, because we have had a cash-based tax system for the last 25 years. And although the 2% is not like a large figure, then hybrid taxation based cash-based and accrual-based causes significant confusion, probably, and in case of some business models leads to some unfair situation also. For me as advisor, that provides additional work, of course. For me as a citizen, it brings some frustration. And some issues with taxation of unrealized profits, some examples. We have a cash flow challenge, because companies may face difficulties because unrealized gains do not represent actual cash flow To pay taxes, company might need to use liquid assets to take a debt. Timing of taxation, of course, if the value of assets decreases after unrealized gains have been taxed, the company may be forced to pay taxes on asset values that no longer exist in reality. The biggest challenges are with real estate investments as well as financial investments, particularly for unlisted shares. And it is highly recommended to consult with accountant or auditor to review the accounting methods. We can give you some examples where the accounting rules, which are sometimes quite flexible, have a great impact, direct impact. Fixed assets, for instance, a useful life recognition and threshold. There is a motivation probably to raise the threshold, treat items with fixed asset characterization as periodic expenses instead, and show also a shorter useful life. Or a write-down of receivables and inventories to act significantly more conservative. It is likely the approach here. Expired and slow-moving inventories can be written down, for instance, as well as overdue receivables. However, clear criteria for this accounting principle are lacking. So that's like, again, have to be consulted with auditor and your accountant here in Estonia. So let's move forward with individual taxation. Here the logic is not so much different than for the corporations. The new defense tax 2% is applicable to all active and passive income. And also the wages earned by a Estonian resident working in abroad, and also dividends received from abroad. And that's also applicable to non-resident income from Estonian sources, both for the individuals and companies. But in case of companies, of course, we have to rely on the tax treaties. And for the defense tax is treated as income tax for the purpose of a tax treaty. So if a tax treaty provides exemption on such income, then there are no additional withholding. But otherwise, if the income is paid out to resident individual or non-resident individual, then it is paid, if it's income, then it's paid through a withholding, additional withholding. So we have an ordinary income tax, 22%, but we have to withhold not 22%, but 24% next year. About defense tax, if we're talking about individual taxation and corporate taxation, we are talking about 2026. If we now soon talk about the VAT, then we have to, that applies already this year as of 1st of July. What is relevant to understand is that the defense tax on the income of individuals is applied on gross income. It means regardless how big is the basic exemption, it's not available. Basic exemption will apply for ordinary individual income tax, which is 22%, but additional 2% is calculated and will be paid on the full gross income. Except dividends received from Estonian companies, if those dividends underlying profit has been already taxed with a defense tax in Estonian corporate tax system, then these dividends will be exempted from additional taxation at the individual level. And first declaration must be submitted if we're talking about individuals for the 26 in spring 27. And resident companies, as said, must withhold defense tax from the payments made to individuals. What maybe should be also mentioned that there will be no additional tax returns as such. Regardless, it's individual tax, defense tax applicable for individuals or for corporations or VAT. Everything will be handled and declared through existing tax returns, which will be amended partly, of course, because of temporary nature, so to speak. But as mentioned before, let's see how temporary it will be. Besides the defense tax, we also have some minor corporate income tax changes besides the rate in 25. First of all, and most important, of course, is the tax rate. The standard rate has been increased, as mentioned already in the first slide, by 2%. And what can be said? The biggest problem is the tax competitiveness between tax jurisdiction in Baltics. It doesn't have so much effect on maybe the effective rate on ultimate beneficial here in Estonia. If we compare the effective tax rate between Baltic countries, Estonia probably will remain the cheapest, the lowest, even after those changes. But if we compare the corporate tax rates between the countries, specifically maybe between Estonia and Lithuania, then the difference is rather big. And if Latvia does not decide to raise the corporate tax income during 25, then the Estonian advantage will quickly disappear, purely in terms of tax system comparison, of course. And about this reduced rate here, that has been abolished, the removal of this rate on regular paid dividends is primarily a loss for the foreign owners. It doesn't have so much effect on the Estonian shareholders, but more for the foreign investors, because they cannot deduct or offset the Estonian corporate tax, because although it's paid mainly on dividends, that's not the dividend tax, it's a corporate tax in the meaning of tax treaty. And the last about this notice here, this is because, you know, we have a cash-based system, and this is not the defense tax. This is the cash-based tax, which is also applicable in Latvia, but also here in Estonia, which means that although the rate increased as of 1st of January, but if some of the income, let's take the payroll, if December salary was paid out not at the end of December, but in the beginning of January 25, then because of a cash-based taxation, already the increased rate 22 instead of 20% will be applicable. So here are some, for businesses, some tax-free expenses limits have been also improved, and scope of some expenses have been expanded. You can later review here, and that's you can also follow and see the comparison table. We have different compensations available, some different tax-free thresholds, and you can compare the last year with a new year here. And you can see that many of them has been increased quite a lot. So that's only good news for the taxpayers, for the corporate taxpayers. So I will not waste time more here. It's quite self-explanatory. And some changes in personal income tax. Now we're talking about only the personal income tax, not the defense tax part. Similarly with corporate tax changes, also the ordinary income tax rate has been also now increased as of 1st of January by 2%. There are some options available for employees to choose additional distribution to the second pillar pension system instead of 2%, which is for many of us even mandatory. They could opt up to 4 and 6%. And there are some very specific changes applicable for bonds and crowdfunding loans, which can be now also added to the investment account. That's kind of incentive available for the individual resident taxpayers to defer the taxation on investments. And what is quite good news, at least for Estonian individual tax residents who are more active in trading with crypto assets, and now is treated as such type of financial asset where you can offset the losses against the gains, which was not possible. And even better, if exchange platform is compatible with MiCA directive, then even such gains can be included to the investment account system. And that's, I think, all from my side, and I will now give over the word to Jaana, please.
Thank you, Kristjan. So as Kristjan previously mentioned, we had the tax festival. So we have additional new tax type, which is the motor vehicle tax. So it's going to be consisting of two parts, but main part is the annual tax that is now from this year, and it's going to be applicable to all motor vehicles that are registered in Estonian Traffic Registry. And it can be paid in two parts, but so soon enough, owners of the vehicles will receive their first tax notice by 15th of February through Estonian Tax Authorities portal, so EMTA. So the owners should all look out and wait for that. And in addition to the annual tax, there's also a registration fee that is applicable to the first registration of the vehicle in the Estonian Traffic Registry. But the vehicles that have already been registered, for those the registration fee will also apply, but it will be charged on the first owner change that will now take if they, sell the vehicle starting from this year. And both annual tax and the registration fee have kind of the same components from which they're calculated. So they have the fixed base rate, then they have the CO2 emissions, the weight of the vehicle, and the vehicle age. And the vehicle age will actually gradually reduce the amount of tax payable until 0. And with the electric vehicles, similarly, it's going to be a proportional calculation. And for fully electric vehicles, the CO2 emission part is just taken out. And Tax Authority has actually prepared a calculator, so you can already go and check out what might be the payable tax amount. So we will provide the slides later, and you can go and look at it. Now, in value-added tax, there are also some changes. As already mentioned, the standard rate will increase from 1st of July from 22 to 24. But in addition to that, we also have the increase of VAT rate on accommodation from 9 to 13, and the increase of VAT rate on press publications from 5 to 9. But more interestingly, there are changes in the taxation of real estate. So previously, the sale of real estate intended for private use was a taxable supply before this real estate was taken into use. So after the real estate was taken into use, so someone was living in it, the sale of that real estate was tax exempt. And now with the new changes, the sale of the real estate will remain taxable for 1 year after it has been taken into use. But the taxation applies only to the first sale. So if within that year the real estate is resold like multiple times, only the first sale will be taxable. The other ones will remain tax exempt. And this is mainly done to avoid this kind of situation where they're taken to use for like a short period of time to kind of then benefit from that tax exemption. And then kind of connected, there are also changes to the input VAT deduction, or the logic behind that. So again, previously, input VAT could deducted from the purchase of fixed assets was done gradually over the correction period, which was then either 5 or 10 years, depending on the type of fixed asset. And the correction was done at the end of each calendar year for that calendar year, so for that proportionally. But with this new change from 1st of January, the input VAT, if there has been a change for how this fixed asset is used for generation of taxable supply, this correction will have to be done in that tax period where the change occurred. And it will also have to be done in the full amount. So if a fixed asset has been purchased before and the plan was to use it for taxable supply and the input VAT was deducted in whole, but afterwards, after it's like taken into use, the kind of purpose of it has changed and it's not used for taxable supply, or it's used in some sort of proportion. Previously, you could have spread out this kind of adjustment over the years, but now you will have to do it kind of in that tax period and in the whole amount as well. Then we have some changes associated kind of coming from Europe, actually, because we have this special scheme for small enterprises introduced across EU, and it will allow for less kind of compliance, and the companies who have sales in other countries, they can now operate there without necessarily needing to register for VAT, as long as they have not exceeded the local registration threshold in that country and their turnover in EU is below 100,000 euros. So, for example, Estonian companies who might have some sales in Latvia, as long as they don't exceed the Latvian threshold, they can operate there without needing to register for VAT there. But they might, for example, need to register in Lithuania. So for each country, an application has to be done separately. And the application has to be done with your local tax authority. Yes, so that is actually very positive. But kind of less positive, or at least Estonian point of view, based related with the special scheme, the requirements for tax registration have to be the same, and because of that, the taxable supply threshold will now also include the tax-exempt insurance and financial services, which were previously not included. So for the companies who maybe have mainly have insurance and financial services, but have some amount of taxable supply, now they might have an obligation to register for VAT purposes if, together with that taxable supply and tax-exempt supply, their turnover is over 40,000.
Yeah, I would like to just add that the last one is really nasty surprise so to speak, and should be actually quite similar in Lithuania and Latvia, because it's directly related. It comes from the change of directive. And you should be very careful and look if you have a client or if you have a company, either it's investment company, holding company, or just other operating company having the main type of business as tax-exempt business. You should be very, very careful with any type of taxable supply, even if you, let's see, you have made some re-invoicing some expenditure to the employee, for instance, then that should probably create already the need for a VAT registration already in January. And not only the registration, but the sales VAT must be also calculated and paid on that one invoice. So you have to be very, very careful with that.
Yes.
And yeah, next.
Yes, last but not least, the excise duty. There's not that much interesting, but it will be gradually be increasing on alcohol and tobacco products by 5%, so the rate each year. But what is interesting is that there already previously was this increase of 5% starting from 2026, but now they added this kind of new additional 5%, and due to that, actually from 2026, the excise duty on alcohol and tobacco products will increase by 10%. So that is, at least they took away the additional increase this year as well. So, but that's all for Estonia. And now we'll give the word to our Latvian colleagues.
Thank you, Jaana. So, yeah, thank you all for participating in our webinar. Greetings from Latvia. And unfortunately, I have to say that also this year, this is not an exemption. And in my part, the word increase or increased will be also used very often. So let's move to the first slide. So we have tax rates at glance. First, the corporate income tax. There is no changes in corporate income tax rates. It remains the same. We have 20% on gross profit distribution and 25% on net profit distribution. In personal income tax, we have some changes. We had the progressive rates last year, which was free level rates. It was 20, 23, and 31%. Starting from 25, it is two level progressive rates, which is 25.5 and 33% rates. We have also changes in non-taxable minimum. Now it's fixed and 510 euros for 2025. There are no changes in social taxes for both for employer and employee part. The rates remain the same, 23.59 and 10.5%. Also, there are no changes in solidarity tax. It is still 25%. Minimum wage has increased from 700 euros to 740 euros per month. VAT rates remains the same. It is 21, 12, and 5%, and also VAT registration threshold is the same for 2025. So let's move to the next slide. So changes in value-added tax. Firstly, for the fresh fruits, berries, and vegetables, there is the same 12% rate that was before in 2024. But this time it is not for a defined term, but it will stay as a standard rate for fresh fruits and berries. Then there is new VAT exempt medical services introduced. It is nutritional recommendations prescribed during the treatment processes, pharmaceutical care provided to individuals in pharmacies, and services provided by a mobile palliative care team. 0% rate now is directly applicable to goods and services used for the official needs of Latvian registered diplomatic and consular offices if there is an exemption certificate in place. And before it was applied indirectly, so the supplier charged 21 or reduced rate, and then it was possible to get a refund from the customer side. Then there is changes in principle for determining the place of supply for electronically supplied services and tickets to virtually attended cultural and sport events. So for electronical services, it is only when the services are provided outside of EU territory. And for tickets to virtually attended cultural sport events, now it will follow the standard VAT application principle, that is the place of supply of services. But before it was determined as the actual place for the event and as the actual place where the services was used in case of electronically supplied services. So let's move to the next slide. Also, Latvia has implemented the new EU VAT scheme for small and medium enterprises that is in alignment with the VAT directive. And for the Latvian taxpayers to qualify to this EU directive and implemented rules in Latvia, the total turnover in EU territory must not exceed 100,000 euros annually, and supplies in another member states cannot exceed that country's VAT registration thresholds. For companies in Latvia that will fall under and will use this scheme, will have to receive special registration number and submit quarterly reports to tax authorities so that the tax authorities can follow if the thresholds are not reached. In case the thresholds will be reached, then this simplified scheme cannot be applied. Then there is also expanded rights to taxable persons from other EU member states not to register in VAT register in Latvia. So the first one is from the same VAT directive. If this taxable person carry out taxable transactions in Latvia and the turnover does not exceed the Latvian VAT registration threshold, which is 50,000 euros, and while the total turnover does not exceed 100,000 euros, this taxpayer is allowed not to register in Latvia. This will be applicable from the 1st July 2025. The next is if the value of goods acquired in Latvia from other EU countries does not exceed 10,000 euros, then other EU member state taxable person is allowed not to register in Latvia. This is also applicable from 1st July 2025. And the last is if there is the right of a taxable person established in another member state or third country or third territory not to register for VAT purposes in Latvia, if this person supplies goods in for temporary storage or goods moving from one place of storage to another. And according to changes, this is no longer has to be a customs zone or special zone as it was before. It can also be other temporary storage location places in Latvia approved by the customs department. Yes, then we have also changes in VAT registration threshold value, same as in Estonia. Now some of the VAT exempt transactions will also form the VAT registration threshold, and this is the transactions related to real estates, financial and insurance services. Yeah, so if the threshold has been already reached in 2024, There is transition provisions that allow this registration until the 15 January 2025 without any sanctions. But if the company will have late registration after this 15 January, then the effective date will be deemed from the 1st January 2025. And according to these amendments, the taxpayer can avoid this VAT registration if the threshold is exceeded, but the taxpayer performs only VAT-exempt transactions. So in cases when there is maybe mainly VAT-exempt transactions, but also together with exempt transactions, there are taxable transactions, we recommend to follow if the threshold was not reached in 2024, so that the registration necessary, it could be necessary to register for VAT purposes in 2025. Also there are changes in how we determine the threshold value. So now it will be the calendar year. Previously it was the 12-month period. And also the registration moment now can be postponed at the year end. So we have this 50,000 registration threshold, and if this threshold will be exceeded for up to 5,000 euros, it will be possible to register at the year end. But if the total limit of 55,000 euros will be reached during the taxation year, so the registration will have to take place in the period when this threshold was exceeded. So let's move to the next slide. Changes in personal income tax and social security contributions. So as mentioned already before, from 2025 we have two rates, two progressive rates. First is 25.5%, which is for income up to 105,300 euros per year. And then we have 33% rate for income that exceeds 105,300 euros per year. Then we have increased rates also for capital gains, income from capital, and income from income earned by athletes. If previously capital gains and income from capital was 20%, and now it's 25.5% rate. Additionally, there is a totally new rate, which is 3% to income that exceeds 200,000 per year. And this will be payable through the individual annual report. And this rate is applicable for the personal income tax objects like salary, income from capital gains that could be shares, sale of shares, income from real estate, also income from capital that could be interests, dividends, liquidation quota, so that all type of income is summed up. And if this summed up amount exceeds 200,000 euros, for the excess, there must be paid additional 3% personal income tax. Then we have changes also for the non-taxable minimum. So before we had differentiated non-taxable minimum, which was very hard to calculate and forecast what it will be for each employee, and it was calculated automatically by tax authorities. But starting from 2025, we will have fixed non-taxable minimum in amount of 510 euros per month. And in 2026, it will be increased to 550. And from 2027, it will be increased to 570 euros per month. And also social security contributions, a maximum object is increased up to 105,300 euros. Previously, it was 78,100 euros. So let's move to the next slide. Then we have also some good changes, which is for the personal income tax exempt benefits that employer can provide to employee. So in Latvia, we have a special benefit that for meal and medical expenses. That was in 2024, but this is even greater in 2025, where for meal and medical expenses is added also coverage of employee relocation, accommodation, and transportation services. And in 2024, the limit was 480 euros per year per employee. In 2025, it's already 700 euros per employee per year. And the allowance is calculated as average number of employees in the previous year, as it was stated in annual report, and multiplied by 700 euros. And the benefit amount for each employee may vary. So the employer has the right to define how it is determined, for example, by segmenting employees based on their job positions or any other criteria. But it is important to mention that to apply for this benefit, there is list of criteria that must be met, but one of the most important criteria is that the company must have a collective agreement in place where the conditions of allowance and are specified and justified. And also it is important to mention that for this benefit, the expenses cannot exceed 5% of employer's total annual gross salary fund. And if this benefit will exceed this 5% threshold, then the excess will be subject to corporate income tax. Then there are some other increases. One is the childbirth grant, which is increased from 250 to 500 euros. That is not subject to personal income tax. Funeral benefit is increased from 250 to 500 euros. Employers gift to employees from 15 to 100 euros, and prizes in local and international competitions and contests from 143 to 1,500 euros. So let's move to the next slide. This was hot topic in the end of 2024. As from 1st January 2025, Latvia has implemented electronic invoicing. Firstly, in 2025, it is applicable only for the business to government and government to business transactions and government institutions. We have publicly available site where we can enter the registration number of our cooperation partner, just to make sure that it is not the government institution and that we don't have to use this electronic invoicing. But starting from 2026, also business to business transactions in Latvia will be subject to e-invoice. The file format will be XML, and data that will be used as e-invoice will be automatically uploaded to VAT returns. So then there are some other tax changes, not all, but I have included just 3 positions. There is increase in excess tax for fuel, natural gas, petroleum, and non-alcoholic beverages, alcoholic beverages, and tobacco. Then the excess tax exemption for petroleum products used in electricity generation and cogeneration has been abolished. Vehicle operation tax will be increased from 2025. Rates will be increased by average of 10% for all vehicles, and as well for trailers and semi-trailers. And also there is set payment deadline, which is the 31st January of the year following the calendar year. There is also changes planned for company car tax, which is approved, and it will be effective from 1st January 2027. And also the company car tax rates will be increased by average of 10%. Then there are other changes that maybe is not directly related with taxes, but still important. So financial institutions, banks will be obligated to inform tax authorities about clients whose bank accounts received cash deposits exceed 7,000 euros. Before it was 15,000 euros. So I think a lot of people already experienced that by the end of 2024, the tax authorities sent out the letters by requesting different evidence of source of income and transactions. Now, when the threshold is lower, then we believe that it will be even more active at the end of 2025. Then retailers and other taxpayers who use whose annual turnover exceeds 50,000 euro will be required to provide option of cashless payments. And then there is totally new law introduced, solidarity contributions law, that is applicable for credit institutions registered in Latvia and also for the foreign credit institutions that operates in Latvia. According to this law, the solidarity contributions is calculating by applying 60% rate on the solidarity contribution base. But there will be some discounts possible for the solidarity contribution, even up to 100%. If the credit institution significantly increases the lending volume during the payment period. So this is the main purpose to raise the lending volume in Latvia by this law. Thank you for your attention. I'm giving word to Vykintas.
Thank you, colleagues. Then let's move on to Lithuania. It was much calmer, I must say, even though there were some let's say attempts of tax reform. Ultimately, we do not have many changes, I would say. So here you can see a table with key tax rates. And what is changing notably very slightly, corporate income tax law by 1%, and the minimum wage was again increased, statistical average wage, which is used also for progressive tax calculations, and social security contribution ceilings, but anything else was not really that much adjusted. By the way, also the personal income tax basic exemption formula was amended, but let's dive more into details. So firstly, regarding corporate income tax changes, like I mentioned, standard tax rate was increased by only 1%, from 15% up to 16%. And it is applicable for year 2025 profits, so it will have to be paid by advance income payments quarterly, and then ultimately by June next year. Also for micro companies with up to 10 employees and up to 300,000 euro revenue, there is still smaller tax rate available, but it was increased also by 1%, from 5% up to 6%. And for the first year of such micro companies, still 0% rate is available. The probably biggest change in corporate income tax law rules concerns company cars, and as Lithuania had to implement some kind of CO2 related taxation rules, then the decision was to implement this two corporate income tax depreciation limits. And it consists in limiting maximum car depreciation to 75,000 euro in cases where there is no CO2 emissions. So for electric cars and similar not emitting any CO2. And if the car is emitting 130 grams or less, then maximum deductible amount is only 50,000 euro, which means that, for example, if you purchase a car, company car for let's say 60,000 euro, then you will be able to deduct 5/6 only from your annual depreciation. And in case your car will be emitting more CO2, up to 200 grams per kilometer, then the limit is 25,000 euro. And if more than 200 grams per kilometer, then the limit is only 10,000 euro. So it means companies still can purchase whatever cars they estimate fit for their business, but the government will allow to deduct only up to those limits. Notably, those limits do not apply to car rental companies themselves, but they do apply for companies renting those cars from, let's say, leasing companies or similar. Let's move on then to the next slide about personal income tax changes. And there is one very welcome and long time awaited change of the so-called investment account that allows individuals to designate an account in a credit institution in which they will be saving some of their income and not consuming it. And such income will not be taxed until funds will be withdrawn, so taken away. And notably, until now, it was not possible to consolidate gains and losses, for example, from trading some kind of securities. And it was very complicated, actually, for individuals to comply with all this calculations. So from the year 2025, there will be this possibility to consolidate gains and losses from held financial instruments. And also this account will be available for holding financial products received as gifts or inheritances. However, this investment account will not apply to dividends nor crypto assets, but it will apply to interest income and shares disposal gains or losses. And there is no need to rush currently, as it will be possible, as per tax authorities' explanations, to also designate such account in a way retrospectively upon filling the tax return deadline until 1st May next year. So this is some kind of positive news that in this landscape where in Estonia and Latvia everything is increasing, here we have some positive news as well. Some mixed message here also for the very large groups of companies. As Lithuania had to implement EU directive about minimum effective corporate tax rate, it was decided by the government to postpone for 5 years. So it was implemented, but choosing possibility offered by directive to postpone the effective taxation for those subsidiaries or head offices of large multinationals belonging to such huge groups of reaching consolidated revenue of 750 million euro or more. So nothing to worry about it as of now, and the nearest deadline is to notify tax authorities until 31st December this year about which group entity will be providing full group information dataset. So usually it is a headquarter or a parent entity, but still Lithuanian subsidiaries might be asked by their group companies to share this information required for them, for other countries to report. And feel free to use our resources in navigating Pillar 2 dedicated website that the link will be shared also together with the slides, where a map containing countries having implemented this directive is provided, and you can see then quickly how it can affect your group. Whilst from our Lithuanian perspective, draft legislation amending this already adopted very hastily law is still pending. Most likely it will be adopted sometime in first half of this year. So it is advisable to wait until third quarter of this year to see what is the final redaction of this law and how this minimum top-up tax will be applicable. Given we have 6 months transition period set by our constitutional court, it is quite safe to wait and not to rush, not to stress out too much about what the current legislation is in this field, and it is not yet complete. Some other news, unfortunately, Lithuania did not implement amendments of the VAT directive that both Kristjan and Mārtiņš and Jaana were presenting about those European small business scheme, as well as containing place of taxation of virtually supplied services. And it was also planned to increase the VAT registration threshold up to 55,000 euro, but unfortunately these amendments were not adopted by the parliament, and they are currently still pending with our parliament. It's hard to say when they will be voted, but as of now, it is kind of uncertainty for Lithuanian businesses because all other EU member states have implemented those changes, but not Lithuania. We hope that it will be fixed quickly, and will inform you also through some tax alert. So please register for our tax newsletter to receive all our tax alerts. Note also that a new double taxation avoidance treaty was ratified by our parliament with San Marino. It's a tiny country. Some other weighted changes concern Taiwanese people, and a special law was introduced as draft law to the parliament, but currently it is also pending in our parliament. So a lot to do to our newly elected members of parliament. Hopefully they will adopt those changes as well, allowing to avoid double taxation for transactions with Taiwanese people as well. Currently, it is not yet ratified, unfortunately. Some other changes concern as well, like Kristjan mentioned, sometimes things, temporary things become more and more permanent. So the temporary solidarity contributions for credit institutions, for banks were prolonged for 1 more year. And it will apply as well in the year 2025. And like in other countries, excise duties and vehicle registration taxes were also increased, but we are sparing details here. Vehicle registration taxes were increased very lightly, I would say, nothing too dramatic. Excise duties for fossil fuels were increased a bit more heavily due to adding CO2 impact as well. I believe it was also part of EU green policy and required from EU legislation perspective. I wanted also to mention that the personal income tax non-taxable limit calculation formula was amended, and I will not go into details here, but we have a very brilliant publication by our payroll colleague Inessa Grece, tax laws changes affecting payroll as of 1st January 2025, available on our website with the link provided in the slides. So please consult that publication if more details are required for you in this payroll taxation area. And some sectorial tax reliefs were abolished for healthcare institutions revenue and life insurance companies revenues. We are also not going deep down into details, but please contact us if it is relevant to you. Finally, I wanted also to end on a positive note that corporate income tax investment projects relief for investment into qualified fixed assets remains in force, allowing potentially to reduce corporate income tax rate to 0%. Note that this might have impact if your group is very large and parent entity country implemented this minimum taxation Pillar 2 rules. So again, please consult this Navigating Pillar 2 dedicated website with the link provided. That's all regarding Lithuania. And we will be sharing slides and recording of this webinar as well. You can see by the end of our slides our contact details from myself, as well as Latvian colleague Mārtiņš, Estonian colleagues Kristjan and Jaana, and also Lithuanian colleague Vilma. Happy to help, and if you have any questions, please, it's a good time to ask those in the chat box. So I will check. I believe there were some kind of questions, but replied by Jaana, and unfortunately I cannot see any questions now. Colleagues Kristjan, Mārtiņš, Jaana, if you have any other remarks, final comments or answers to some questions, please feel free to intervene.
Yeah, thank you, Vykintas. A quick remark. I would also encourage you to visit the Estonian Grand Thornton Estonian website, English section. You can find much more details and examples for the calculation and better understanding of this coming defense tax 2% on profits for corporations in 26. It's quite complex, so it's a bit difficult here to a full understanding within such a short time frame. But that's quite practical and useful article, and to explain why we are talking about that so soon, because it's beginning of 25, not 26. It was mentioned also in slides that we will have also the advanced tax payment, and in 26 the advance payments of this 2% on the profits, accounting profits, will be calculated based on the 25 accounting profits. So it's actually, if you want to review the accounting methodology, then it's actually last time to actually consult with your accountant, especially with the auditor, where the current accounting treatment of a specific type of asset is actually reasonable, and what can be actually changed based on which arguments, and how to document that properly. So that's maybe a remark from my side.
Mārtiņš, any ending remarks from your side?
Nothing to add, just thank everybody for participating, and let's hope to see you all also next year.
Hopefully sooner also, but yes, have a nice evening, everyone, and please do not hesitate to contact us if we could help with any kind of your tax questions. Happy to help.
Yes. Good evening to everyone.